Hello and welcome to Talking Points. I'm Dave Kelly, Director of Advanced Media Production at Cal State Long Beach. Today we're going to talk about the economic outlook and the prospects for small business. My guest today is Dr. Wade Martin. Dr. Martin is a professor of economics and he is also the director of the Institute for Innovation and Entrepreneurship. Welcome, Wade, and thank you for joining us on Talking Points.
Thank you, Dave.
Well, as we talk about this subject of the economy and the prospect for small business, we'll start with the national economy, which is in many ways now an international economy. But we'll start with the national and then move to the small business a little bit later. So starting with the economic news, well, today is an interesting day because this is the fourth day in a row that the Federal Reserve Bank has raised the federal funds rate by another 75 basis points or 3/4 of a point, meaning that the interest rate, the benchmark federal funds rate, is now somewhere between 3.75 and 4%. That's the highest it's been since 2008, 14 years ago. And the reason they've been raising the interest rate so much is, of course, because of the inflation, which many are calling runaway inflation or white-hot inflation, because it is running at the highest rate in the last 40 years. It's between 8 and 9% for most of this year. This has affected also the consumer savings rate, which is down from it was a year ago. In September of 2021, the personal savings rate was 7.9%. That's the amount of money that the average consumer can save from income after paying taxes and living expenses and so forth. Well, that rate went down in September of 2022. It's now down to 3.1%. So pretty significant drop in the personal savings rate. And that means that consumers this year are paying more for essentials, they're saving less, and we also notice that the credit card balances ticked up as well. So it means they're dipping into the credit cards more and accumulating more debt. So taking all of those factors into account, what is your take on where we are with the economy and what does it look like going forward?
Well, that's quite a set of statistics to wade through. So basically, when we look at the picture, it's obvious that the Fed has taken inflation as a very serious problem and has been very aggressive at fighting inflation with these 4 basis point increases in a row at 75 basis points. So they've been very aggressive in trying to contract the money supply, put fewer dollars in the market. So much more restrictive Fed policy. That policy, definitely impacts many of the other statistics you talked about. We had 2 quarters of negative economic growth measured by the GDP. That rebounded in the third quarter, so we saw a 2.6% increase. So that was a positive sign. The inflation that you talked about, there's been some positive signals that it may be coming down. And we see that the producer price index has started being reduced in the last month or two. So that from the peak in June, for many of these statistics, things have started to trend downward. So the price pressure measure that the St. Louis Fed puts out, it has started to decline as well, indicating that there's less pressure on these prices of intermediate goods to increase. So on the supply side, in the supply chain, we're seeing signals that things are moderating from an inflation. If you get producer prices coming down, then the consumer goods prices will moderate as well. And although these aren't coming down as fast as we would hope, which is why the Fed took that aggressive action again today, there was a lot of debate in the economics profession as to whether or not they would start to moderate this time with 50 basis points instead of 75. But it is important to note that it was a unanimous decision of the Open Market Committee to do 75. So there's on the Open Market Committee, at least at the Fed, there seems to be agreement as to the need for an aggressive stance. But they did indicate when they announced this that there may be signals in the economy that future changes would be more moderate. So you are seeing signals there. You also see things like building permits and construction costs going down, starts going down. So that's showing a slower economy, so there's less pressure there. You see things like an inverted yield curve, where short-term rates all of a sudden are higher than long-term rates, indicating that people want to get access to their money more quickly. They're not investing longer term. So that shows some economic uncertainty that they want to have that flexibility. So, I think there are positive things you're seeing in the economy, positive trends, but it's really sort of too early to start saying, yes, everything's coming into place and we're going to have a booming 2023.
If we talk about the producer price index that you mentioned a moment ago, isn't it also true that the inflation or the higher prices that producers have to pay in order to produce the goods that we end up consuming, isn't that based a lot on the cost of energy as a baseline? Because energy is the fundamental basis of all kinds of production today, and
Yes.
everything has to be delivered. And if it has to be delivered, it's going to involve some sort of fuel.
Yes.
We know that there were some policy decisions made in early 2021 in terms of oil that have now found the U.S. scrambling to come up with adequate supplies of oil and most recently diesel, gasoline and diesel. And the prices have gone up and they've come down because we've tapped the Strategic Petroleum Reserve.
Right.
And as a result, the producer prices have stayed high because they do have to pay that initial cost of the energy to produce the goods. So is it unrealistic to think that prices will come down dramatically until we can find the abundant source of oil at the right price to keep those prices down? Or do we have to accept now that we're into an area of new normal, so-called new normal, where we're going to have to pay higher prices for products?
I think that if you look at a commodity like oil, the price historically has been very volatile. So there will be periods where it puts real pressure on the economy and producer prices, and you will see that. But about the time you think that, okay, this is the new normal, then something else happens and the price collapses in the oil sector. You saw that in the 1970s with the so-called embargoes, where the price of oil was run up to historic highs in real terms. And then in the early 1980s, the price of oil was the cheapest it's been in decades. And so you see that volatility. If you look at the more recent price movements, you can see over the last year, the price has changed, about 7%. It's about 7% higher. So it was, for West Texas Intermediate, was about $80 a barrel a year ago. Now it's about $88 a barrel most recently. So you see that. But if you look at it from the peak in June, it was $120 a barrel, and now it's down to $88 a barrel today. So you've got these movements that are very unpredictable and are very much influenced by activities in the world. So if you see something, for example, like a resolution to the Ukraine-Russian war, then you will see more oil on the market from Russia. That could depress the price. If you see countries in major producers, and the three major producers globally are Russia, Saudi Arabia, and the United States. And so those three major producers can really move the market. And like you said, the U.S. has tapped the Strategic Petroleum Reserve to help moderate prices. But until you get some resolution at the global scale and understand, what's going to happen in the future with a little more certainty, then I think you'll see oil prices moderate, the producer price index reset, and you'll have these different results that you can see. But I think the only thing certain in the oil industry is that price is going to be volatile.
If we talk about the stimulus and
Yes.
The stimulus funds that were released to the population in the United States, and there were also stimulus funds in a lot of other countries around the world during the pandemic. And a lot of people would say, well, it was the stimulus that saved the economy, that kept us going in our darkest hours. But at the same time, a lot of commentators are saying, but all of that stimulus money, we spent too much. That's what is driving up government debt. That's why they have to raise the interest rates. What are your thoughts about that? How did the stimulus save the economy, and how did it also put us in a position to have to pay higher interest rates today?
One issue that is prevalent in the economic history literature is that the Great Depression, this is the 1920s, 30s, that are basically in early 30s to the World War II. And basically the discussion has been, or the conclusion has been, that the stimulus wasn't enough, that the New Deal legislation in trying to balance the budget that the Hoover administration did, that prolonged the Depression. And so the basic lesson coming out of the research from then is that the stimulus wasn't enough. And they tried in the Great Recession in 2008-9 through stimulus packages, through bank bailouts, et cetera. They tried to inject capital into the system and tried to do so at a larger scale, and to make sure that it didn't turn into a decade-long problem. And that they found was more effective, that we were able to turn things around, but that was still 4 years before, from 2008 or 9 to 2010, 11, 12, to really see the impact of that stimulus package and injecting capital into the financial institutions. And so when the pandemic hit, trying to learn lessons from those events in particular, they did inject significantly more, an order of magnitude more money. I mean, we were talking about trillions of dollars being injected into the economy. And so people couldn't leave their homes and go to work, but yet still had to pay the rent, pay the bills. Some places had rent freezes and tried different tactics, but pretty much globally, it was a lockdown in many countries. And when you see something like that, that deficit spending becomes necessary so that we don't have even more tragic results of people not being able to pay their bills and buy food, et cetera.
Now, on that note, we have to go to the break. Unfortunately, we've run out of time in this first segment.
Okay.
But stay with us. In the second half, we will talk about small business and what the prospects are going forward. Stay tuned.
Here you go.
Thank you.
Thank you.
Welcome back to Talking Points. I'm Dave Kelly, and my guest today is Dr. Wade Martin. And Wade, before we went to the break, we were talking about the stimulus, and your answer was that it was necessary. It was definitely necessary. The argument now is basically, well, was it too much or just right?
And there are some that say not enough. I mean, so as with most economic questions or economic issues, you get the whole spectrum of opinions.
Okay, on that note, let's move on to the small businesses, because we said at the beginning of the show, we're going to talk about the small businesses and the small business environment as it stands today. Now, we know that during the pandemic, a lot of small businesses went out of business. So in retrospect, in hindsight, did we do enough to save the small businesses, and should we have done more, and what have we learned, and what should we do differently in a similar circumstance in the future?
Yes, that's always the very challenging question, because small businesses, just by their nature, last anywhere from a year to 5 years. Many of them go out of business within that time frame. So trying to do enough to make sure that they didn't go out of business because of the pandemic, or they didn't go out of business for just natural reasons that most small businesses actually go out of business. That is the challenge that policymakers have in trying to design policies to support small businesses, since they are so diverse in their structure and what they do, is also another challenge. So the programs that were set up, many of them locally, city governments put in programs because they would get grants from the federal government to support local businesses, and then each community was charged with designing the programs themselves. And so, speaking of what happened here locally, there were many of these programs like payroll protection that were direct grants to these businesses that helped them stay in existence, stay in business. They could count themselves as an employee, so they would receive some money, even though they weren't able to open their door. But many of the programs were set up as loans. And then after a year or whatever, they were forgiven loans. So I think one of the biggest problems with the programs, the way they were set up, is there wasn't certainty. Many small businesses are afraid to take on debt because they're really living month to month, making their bills, making their payroll. But then when you sit there and say, okay, we're going to loan you money to get through the next 3 months, and they don't have the expectation that it's going to be forgiven, then that provides an element of uncertainty that they have to say, what's going to change in 3 months that would allow me to repay this loan? And so I think one of the biggest lessons that I would advocate is that you needed more certainty in these programs. If you're going to make them a grant, you're going to make them forgivable loans, state that up front. That, okay, here is a grant that you will get, and it will allow you to keep your employees, and you will not have to close your doors forever. I think that if they have that uncertainty, they can plan around that. Many other businesses were able to pivot and take advantage of this and begin to develop their e-commerce platforms. And then, so what they did was try to redefine what it meant to be a local business. They used their e-commerce platform to create a community around their business. And that community was defined by a community of interest, not necessarily community of place. So whenever we talk about buy local, it's more that community of place. You're buying from the store down the street. They're selling products made by the artisan in the neighborhood, these type of things. But really, when you pivot and you're able to develop your e-commerce presence, what you're seeing is they're trying to find this community of interest. And they may live in diverse places around the world that you have a global reach. And now if they see, oh, this leather shop in Long Beach makes these really nice artisan belts, and we'll buy them there, but they become that community of interest around that product. And so that really helped a lot of small businesses stay viable until they were able to open their doors again. And once they opened their doors, they had some resources that would allow them to attract those local customers back to them. So then it became not only a community of interest, but also that community of place. And the arts district, some of the businesses in the arts districts here in Long Beach were classic examples of that.
Well, let's talk about some pending legislation that's been considered for California regarding minimum wage and some other regulations for business related to the minimum wage. They're talking about a starting minimum wage of about $22 an hour for certain industries such as fast food. And so the question is, although it's well-intentioned to give people a living wage for whatever job they're doing, the truth is that if it's a small business that's running a fast food operation, it's going to probably be disruptive to that small business or add an extra burden. And if it's a chain of fast food establishments, they're probably going to start looking at technology applications to replace labor, such as kiosks and areas where people can order their food online and so forth so that they can reduce the human labor. So how should we look at that in terms of minimum wage and its effect upon employers and on the encouragement of technology to replace workers?
Yes, you can already see in places like grocery stores where self-checkout, you can see in fast food restaurants, like you mentioned, where you can go in and they'll have a board, you can just touchscreen order what you want. So you already see technology making inroads into this. Visited a cloud kitchen recently where they're going to have robotics to help packaging the food for customers for delivery. So you are seeing technology make inroads into what traditionally has been human labor. And trying to create policies that delay the adoption of technology is problematic. You can think back historically with the railroads continuing to require a fireman on the train when they switched to diesel engines from coal-fired engines. And so that person just rode the train all day. So yes, businesses do the calculation. They say it's cheaper to go with this technology versus human labor. They're going to make that switch. And that's already happening. And you can see that trying to regulate, that becomes problematic because you can't really hold back innovation and technology. What you have to do is complement it with other activities. But you're already seeing stores like Starbucks that have to pay in the $17, $18 an hour to get labor. So there are labor shortages at this entry level. And so, one thing is regulating a minimum wage for industries or for jobs where the risk is higher for healthcare workers. I think Long Beach just recently had approved a wage for companies in the medical industry to $25 an hour, I think. But part of the unintended consequences of that is everybody in the business has that wage, not just those doing the medical work and having the higher risk position. And so it's everybody. If you're in lawn care or a receptionist at the front desk, you are covered by that. And so that becomes problematic. So yes, whoever's the policymaker pushing this, there is the calculus. A minimum wage by itself, economic theory will tell you, may improve the overall condition for those working, but you may have fewer people working. That's always the trade-off.
Let me just continue on with the area in the interest of time, because we are starting to wind down here. In the interest of time, let's talk about technology. So technology is obviously one of the areas of potential growth. What are the exciting, innovative areas of technology that you think hold promise for small businesses and medium-sized employers?
Small businesses really have a tough time adopting technology. They don't necessarily have the expertise. So if you look at it in two ways, one is how can they use technology to improve the product or service they're delivering. And so their businesses are now able to adopt things like artificial intelligence to help with their customer relations. They're able to use 3D printing to try to manufacture some products. The cost of 3D printing has dropped dramatically over the last few years. They can use things like blockchain technology to help with their, to develop a more secure supply chain. So all of these, what has happened is they're not just available now to large companies that have the internal technology expertise. They are becoming affordable for small to mid-sized business, SMEs. They're able to take advantage of these innovations. Now, as far as these technologies sort of replacing small businesses, that becomes much more problematic. What is defined as a small business? Like the SBA says, anything less than 500 employees, and that's a pretty good sized business right there. So small is relative. But I think what you're seeing is businesses finding opportunities with technology to enter the market and provide these technologies to small businesses.
We're almost out of time. We've got about a minute and a half. So in that last minute and a half, I want to talk about the advantages that we have here in Southern California. And if I'm an entrepreneur and I want to start a small business, why would I come to Southern California?
Yeah. I think one of the things in Southern California that we have that is hard to replicate is the education system. You have a very educated workforce, and that's why you see like California is the #1 economy. It's positioned next month to become the #4 economy in the world, surpassing Germany. And so the California economy, you have access to markets here, you have access to the world through our ports, you have the freeway system to get to the rest of the US, the rail system. So California has a lot of advantages in getting your product to market. And that educated workforce is tremendous. And also access to investors. When you look at the venture capital investments in the United States or even globally, California by itself is the leader in investment money there. China has increased its investment in technology and startups, but really California with Silicon Valley, Southern California, Silicon Beach, soon to be Silicon Mountain with other investors. So there is a lot of resources here, plus the quality of life. There's a reason 40 million people,
which is why we all live here.
Exactly.
And on that note, we will have to wrap up because we have run out of time, but thank you for being here today.
All right. Well, thank you for having me. I enjoyed the conversation.
And thank you for joining us on this edition of Talking Points. Be sure to join us again soon for the next episode. Until then, I'm Dave Kelly. Have a nice day.